Hello everyone, welcome back to 𝐾𝐿 TV. This is Sage. You're watching the Executive Corner, Expert Talks, and on today's show we have Mr. John Cowling, the CEO of the Australian Shareholders Association. Are you a shareholder? Or, well, if you're watching this show, you possibly are or have an interest in it. And on that note, have you ever got confused by the regulations associated with your stock trading? Well, today's guest will be sharing insights about navigating the rights of Australian shareholders, so please stay tuned. We bring you the industry leaders, successful business owners, market and equity advocates, all under the one roof to help you discover the insights of the stock markets. So you may have already heard of today's guest, Mr. John Cowling, the CEO of Australian Shareholders Association. And to give you some background, ASA educates investors and stands up for shareholders' rights, Australia's largest independent, not-for-profit individual investor association. Welcome, John. It's a pleasure to meet you.
Good afternoon.
So I'm sure the viewers are very keen to hear your insights, so let's get started. How does Australian Shareholders Association educate investors and ensure protection of shareholders' rights, please?
Okay, so you've raised two issues there, so let's split them and talk about them one at a time. First one is, how do we educate people in investing? Well, I'd like to use a tennis analogy if I can. If you wanted to learn to play tennis and you didn't know how to play tennis, you could read about the rules, you could listen to previous champions talk about their careers, you could even watch a video on how to hit the forehand and the backhand. But that wouldn't make you a tennis player. You'd go out on the court and you'd be in a right pickle. So how do you become a tennis player? Well, you go out with a coach and you hit the ball. And after 10,000 hours, you'll be an expert. Now, we all haven't got 10,000 hours to play tennis, but that's what you'd have to do. You need experience. And that's what we understand. We understand that you can read a lot about investing, you can listen to podcasts, you can hear the experts talk, but what you've actually got to do is you've got to get some experience. Okay, so how do you get experience? Well, the best way is to meet other people that have got that experience, that have learnt the lessons of investing and have made the mistakes and made some good wins, and talk to them about how they did it, and then try it yourself. So that's what we do. We give formal education in terms of videos and webcasts and podcasts and written material, but we also arrange for people to meet in groups. And so younger investors or inexperienced investors or somebody new to investing can sit down with people that know what they're talking about, that have been through years and years of experience on the stock market, and talk to them about how to do it. And that's the best way that we think you can learn. And so that's the difference between knowledge and experience. Knowledge with no experience is no good. Experience with no knowledge, I suggest, is equally bad. And if just knowing stuff was all you needed, well then every university professor would be a millionaire, but they're not, because they haven't had the experience of going in there and investing. Now, you talked about investing, us looking after shareholders and sticking up for shareholders' rights. Well, our organisation's 60 years old. And 60 years ago, there were some people in Melbourne and some investors who were fed up with companies pushing them around and not treating small shareholders properly. So they ganged together and set up what is now the Australian Shareholders Association. And what we do, we have 200 volunteers that help us. 100 volunteers watch companies and 100 volunteers help educate, as I just explained. Now, the 100 that watch companies, we call that monitoring. They watch companies very, very closely. And then they go and meet the company and they talk to the chairman of the company and directors on the board, and they ask them about 4 things, principally. Number 1, the composition of the board, because the board of a company is the most important organ of a company. It actually oversees everything the company does. It approves the strategy, it employs the CEO, it checks the CEO is doing the right thing. And so that board has to be experienced and has to have skills. Now, Many companies, many years ago, used to operate on the old boy network. And so who you knew is, most boards were stacked with accountants and lawyers and friends of the chairman. Well, that doesn't do it anymore. You need to have a range of skills, a diversity of skills, a diversity of people with different attitudes and different experiences on a board to help oversee the company. So we interrogate that very, very closely, and we make sure if a board is well constructed, we say good on you. If it's not, we complain about it. I'll give you an example. There's a company here in Australia called Telstra. It's a big telecommunications company. Well, a number of years ago, it had hardly any expertise on telecommunications on the board. And the chairman, John Mullen, has changed that. And he's now got technical directors that know what they're talking about in the telecommunications industry. The other thing is, as we all know, most young people are on phones these days with smartphones. Everybody's got a smartphone. But they had nobody under 50 years old on the board. Well, most telecommunication companies are selling to young people, not to old people. So John's done a great job. He's got young people on the board as well. So that's been really important to change the composition of the board and the mix of the board. And we interrogate the companies of what are they doing about managing risk. How did they manage the COVID situation? How are they managing the demands of global warming and decarbonisation? We want to know all about that. Then, we're not finished. We asked them about the way they communicate with small shareholders and why they protect small shareholders. And so if a company has to raise capital, does it ensure that small shareholders are treated fairly? And lastly, we check on the remuneration of the directors and the remuneration of the CEO to make sure that the signals that the remuneration policies give to the company are the right signals. Now, again, here in Australia, we had a Banking Royal Commission that showed that many of the banks had remuneration systems that drove behaviours that was looking for short-term profits, exploiting customers, charging customers for no service. And these poor behaviours were driven by a remuneration system that was established with the wrong signals. So we like to talk to the board about what sort of signals are they giving to management and what sort of culture are they causing the company to develop. And so they're the things we do. And if a shareholder doesn't know how to vote, they can give us their proxies. Every shareholder for every share gets a vote. And if they don't know what to do, if they don't know how to vote on a company's resolution, they can give us, or they can read about what we think about how they should vote, or conversely, we'll vote for them.
Very interesting insights. Thank you so much for sharing that. And as we know, to navigate this space successfully, you really need to have a good headspace and a good mental consciousness and yeah, you know what I'm talking about. Being clear up there. And I think hanging around other people or networking with other people who want the same thing can help that in some way.
Well, one of the things that you're referring to there, of course, is that each of us have biases we don't even know we've got. And so I know I've got two deadly biases that I have to control. And talking to other people, they come out. I'll give you an example. I'm impatient. So I hear about a stock, I think, whoa, that sounds great, I think I'll invest. When I talk to other people, they say, John, take your time, be careful, study, make sure you've done your due diligence, you understand what the company does before you go out and buy it. Put your money into an investment like that. So that particular bias is one I've got that I can control by talking to other people. The other bias I've got, which I think most people have, is that if I know of a stock, there's a stock here in Australia, Mineral Resources. When I first saw it, I thought, this looks good, $20, I think I should buy that. And then the share price went up. And so that gets to $40. But stuck in my head is the original $20. So I'm anchored to that price, and I keep saying to myself, I can't buy that. It's double what I used to think it was worth. But it probably is worth 40 or even more. But I'm stuck in my head with the anchor. But when I talk to other people in the association about the company, and they say, oh no, John, I think that's worth $50 or whatever, they say you can afford to buy it now. And it's the same in reverse. I've bought companies where I've paid $10 a share and the shares dropped to $2. And I say to myself, I can't sell that because I paid $10 for it. And so it's anchored in my mind as being worth $10. But if the share price is currently $2, well, that's all it's worth. So I've got to be able to overcome those biases. And in fact, that's talking to other people that some time in the market really helps you overcome those sort of biases. And as you say, keep your mind clear so that you can invest wisely.
Yes, and building up those good habits and just staying informed and talking about it helps you understand it better, I suppose.
Yeah,
so I've noticed...
Yeah.
I've noticed you had your...
Saying there, let me just say something to you about,
yes,
about good habits. I work quite a lot with young investors, and I say to young investors, can you afford $20 a week? And most of them can. And because $20, what's that? A few cups of coffee. If you save $20 a week and you start in your early 20s, by the time you get to my age, if you reinvest that money every $20 and build it up and gets to $500 after 6 months, and you buy $500 worth of shares, and then you keep doing that all your life, you'll end up with a portfolio of $1 million. $1 million for $20 a week. Now, how hard is that? Not hard at all, but you need a good habit. And the good habit is, number one, you save the $20 a week, and number two, you buy sensible shares every 6 months when you've built up $500 in the bank. And you've got to keep doing it. And the last thing is, you've got to start now. Don't wait, because if you wait till you're 30, then you're going to have to save $40 a week. And if you wait till you're 40 before you start, you will never get there. But if you want $1 million in the bank, start now, $20 a week. When you've got $500, buy $500 worth of shares and just keep doing that all your life.
That's very sound advice. Thank you so much. Act now, don't hesitate. Thanks, John, for those insights. Now, I've seen you had your annual investor conference recently and you had some big guests there. You had Fortescue Metals Group. I think you had Origin Energy. Would you please shed a bit more light on the types of events you hold and the clientele that gets involved with these events?
Yes, well, the biggest company, one of the biggest companies in Australia is the CBA, and Catherine Livingstone is the chair. She came along. One of the biggest companies in the world is BHP. He came along. So our reputation as an organisation representing retail shareholders is very strong and respected by all business leaders. And so our conference, we attracted 25 of the business leaders in Australia and commentators in the market. And that's what we do at least once a year and sometimes twice. And throughout the year, we run webinars which are available to our members to watch during their lunch break. And here we run them from 12 to 1, and we get industry leaders or experts or fund managers or stockbrokers or stock tippers, and our members love to eat their sandwich lunchtime and watch these experts talk about their shares. And we run a couple a week, as we run podcasts, as we prepare a magazine. But the whole focus is on expanding the knowledge of our members on investing, not just companies, but investing theory, and how to overcome the biases that I know we've all got.
Fantastic. Well, everyone's situation's unique, so it's about finding your own style and finding your groove, I suppose, in what's going on. So how do you see Australian Shareholders Association evolving in the coming years?
Well, we as you heard me talk earlier, I'm very keen to help younger people understand how to accumulate wealth. Now, here in Australia, when I bought my first house, I had to pay $27,000. Now that house now would be worth a couple of $1 million. So what was relatively straightforward for me to accumulate wealth as an individual was to buy a home, and that was my first and only consideration. And shares came along later when I got a bit more money. Now young folks today haven't got a chance of saving up for a $2 million house if they've got a normal job. But they can build wealth, like I just explained to you, by just getting into a good habit of saving and progressively investing money in the stock market, carefully of course, and just leaving it alone, just letting it compound, letting the power of compounding build their wealth for them. So that's my number one consideration, how to help younger people accumulate wealth without having to shackle themselves to huge mortgages and buy a house and then never being able to do anything because every cent is going to pay off the mortgage. I wouldn't like to be in that position. I wouldn't encourage anybody to be in that position, but I do encourage people to try and build their personal wealth so by the time they get to retirement age, without destroying their spending in the meanwhile, they've built enough money up to be able to have a dignified retirement. Of course, when you're 20, being 70 seems to be so far away you couldn't care less. But that's a big, big mistake. And you don't have to put too much money down. So I wouldn't go and get a $2 million mortgage to buy a house if I was 25. No way. I'd rather rent. But I still need to accumulate wealth, and the way to accumulate wealth is to have good habits when it comes to spending and saving and careful investing. And that's what we want to do. We want to help people.
Yes. And best of luck with your mission, John. That sounds like an incredible mission statement. And thank you for sharing your insights today on the show. I'm sure the viewers have been very impressed. Was there anything you'd like to add before we wind up for the day?
No, I just thank you very much for the opportunity to present. And if anybody goes and searches us on Google, come along and see for themselves or drop me an email. I'm always happy to talk to anybody to help them improve their own financial well-being.
Thank you so much again, John, for your time. And viewers, you heard it from Mr. John Cowling himself, the CEO of the Australian Shareholder Association. Act now, don't hesitate. Start saving that little bit every week and it will add up. If you've just joined us, the full recorded interview will be available from the YouTube channel 𝐊𝐼𝐴 Media in the next couple of days. And thanks for your time today. And as we say, stay apprised and invest wise with 𝐊𝐼𝐴.